Hello, welcome back to the Real Estate Wealth Care Academy. My name is Jim Henneberry, and today I'm going to take you through the frequently asked question video number 2, which is how does negative gearing work? Now firstly, I must tell you I'm not an accountant, so any advice you get on tax should come from a professional. I have been around the real estate industry though for 30 odd years, and I have picked up a little bit of knowledge about it, so maybe I can just explain to you what negative gearing is. In my experience, tax can be as simple as you want it to be or as complicated as you want it to be. What we'll be doing is simply explaining the principle behind negative gearing. To do this, I have a slide here which shows you that what happens if you have expenses on a property per year of $28,000, but your income is only $20,000. There is a shortfall of $8,000, and that is what we call the negative geared amount. On the next slide, we have another example of income being $20,000, where the expenses are now only $18,000. Now you have a surplus of $2,000. Now with property investments, if you have a shortfall, you are allowed to deduct that from your salary. So if you're on $78,000 for instance, and you lose $8,000, your new taxable income is $70,000. If, however, you're on $78,000 and you make a $2,000 income, a positive income, you are now going to add that $2,000 to your tax or to your taxable income, and you're going to pay tax on $80,000. So a simple definition of negative gearing is if you have to feed it financially, it's negative. If it feeds you, it is positive. The Australian Taxation Office provides us with a property investment guide for rental purposes, and this guide is very advantageous for you to have a copy of. You can download it from the ATO site or email us and we'll send you a copy of it. Now on page 22 of this particular report is a good worksheet which is very simple to use, and all you do there is list all the deductions on your property. The main one of course is going to be interest on your loan, property management, strata fees, the shire and water rates, repairs and maintenance, maybe some gardening expenses, and another tax deduction called depreciation, which we go into further in another video. Now if I move on to these other slides, what I want to do is explain to you a thing that we have in Australia called a tax creep. Now I'm not talking about the Treasurer Wayne Swan here, I'm talking about the bracket creep that actually happens as you earn more income. On the first $18,200 in 2012, that amount of your salary is tax-free. But from $18,201 on the segment up to $37,000, you're going to be taxed at 20.5%. From $37,000 up to $80,000, the taxman is going to take 34% from you. From $80,001 up to $180,000, the taxman's share is 46.5%. Now, of course, this includes Medicare levy, but it's still a high chunk if you're getting above $80,000 salary. At the Real Estate Wealth Care Academy, we have software here that analyses property investments before our members do invest in the property. I have put through a sample to populate this page 22 for you, and in here what I've done is it says if we had a property of $400 per week rental and we had a 2% vacancy factor per annum, we would have a rental income of $20,384. However, from our income we are now allowed to take away the expenses, and on this example, renting this particular property out, advertising we've allowed for $300, borrowing expenses which can be claimed as well over 5 years I believe is $895, council rates $1,200, depreciation on the building and furniture works out to be $9,475, insurance cover is $700 to cover the building, interest on the loan is your big deduction, $27,504, land tax we've allowed $300, the estate agent's fees will be $1,982, repairs and maintenance of $400, and we've got water charges of $900. The total of that comes to $43,656. Your tax return is going to look a little bit different now. Your current income on this example is $80,000. your rental income is added to that. So that $20,384 means your taxable income has now jumped to $100,384. However, you are allowed to deduct from that your rental deductions of $43,656. Your new taxable income therefore becomes $56,728. Your current tax that you'd pay on your $80,000 was $18,747. Your new tax, however, on the $56,728 comes down to $10,834. You're getting a tax rebate or a deduction of $7,913. So to feed your investment, you need to put in, after tax, $4,989. That's a weekly investment from you of $96 per week to buy this property. So on the pie graph here that I was showing you, the taxman contributes $152 per week, you contribute $96 per week, and the tenant contributes the rest. So this is why it's easier to buy a rental property in Australia, because instead of you buying your own home and paying it from after-tax dollars and you're paying your own mortgage, here you have two partners, you have the tenant and the taxman all contributing to the purchase of your investment property. Now, I hope that explains negative gearing for you, but what I'd like you to do is, if you have any questions regarding this matter, log on to my website www.realestatewealthcare.com.au and send me through an email. I'll see you on the next video. Thank you.